Hello, Maverick traders. Welcome out to this live trading event. It's nice to be here. Corey with you today. And we're going to talk about opportunities in the markets. We'll kind of do a typical top-down approach, assess kind of what's happening in the markets in terms of risk, reward, probabilities. Volatility is a big factor. You're seeing multi-billion-dollar corporations gapping 20+%. I mean, the Walmarts and the Targets of the world getting demolished, Cisco overnight. There's just a lot of volatility, and really it speaks to bear market environments. In a bear market, you just see more of these types of things happening where there's just simply more volatility to deal with on both the upside and the downside, and that's the nature of it. So with that, let's come over and take a look at the S&P and kind of assess things together. It might surprise you that I'm still a little kind of optimistic that we're in a corrective phase to the upside. Now, there's a lot of pessimism out there. There's a lot of negativity, but the reason I say that is look at the debacle on earnings of Walmart and Target and others this week, and we're still above last week's low. I mean, that speaks to something in play here, that actually stocks generally are a little bit higher. Also, the most beaten down segment, if you look at that really high growth tech type of sector, it's actually been in a little bit of a recovery and a correction. It led us to the downside. And the way I like to think about this is my own saying here lately, has been dominoes. If you line up dominoes and you tip over the first one, it tips over the next, which tips, and they all tumble down. Well, who was at the back of the domino line? It was the largest market cap stock around, and that is Apple. It's the biggest weighting in the S&P 500, and so far this year, it was holding up relatively well, meaning it was in this big basing pattern while stocks were in a deeper decline, right? So Apple has been in this big base. And why do I look at this, it toppling over as a positive? Last week, Apple broke, and it broke hard. But here's the key point. Huge volume at the tail end of that, and see the candle reversal. And what I look at that as is, just like I said, the dominoes. One toppled over the next, which toppled over the next, which toppled over the next. And Apple was like the last domino to fall. And that kind of speaks to, I think, just basically trading sentiment. That now at this point, so much has gone bad that it's actually kind of a good thing. In the markets, there are knowns and there are unknowns. Things that we know about and things that were not priced in and not known ahead of time, and we have to price those in. Well, there were a lot of negative knowns this year. We had, the Fed was going to hike rates. We had inflation as a problem. We were going from QE, easy money policy, to QT, quantitative tightening, less liquidity, winding down the bond purchase program, etc. We had valuations in stocks trading at high multiples and so forth. And then the market hasn't caught any breaks, right? There were some unknowns that were really quite negative. Maybe inflation was even worse than most had expected. Certainly the war breaking out in Russia, Ukraine, that was a big negative, which further fueled inflation. But here's the point. These knowns and these unknowns and these things have been out there now for quite some time. These have been multiple months now that the market has been pricing them in. So my operating thesis is not that the market's off to the races. It's not that. But it's basically a risk to reward of saying, okay, pessimism, if I look at sentiment is in the dumps. Everybody's ready to give up on markets, throw in the towel. Oh, we're never going to recover. Markets are crashing, yada, 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 right? Negative sentiment. We saw the largest outflows of stocks and things last couple of weeks that we've seen in, a decade plus. All of these are known and have been known for some time. So the market's been pricing them in. Why have we been sliding? We've been sliding because of rates and inflation and tightening and valuations and war and all these issues. Now, the question is, at what point is that priced in? And that's why you look for exhaustion type of signals. That's what, to me, that big flush in Apple and the fact that it had massive volume down there at its lows, and you saw other things happening, crypto collapsing and Terra Luna collapsing. These are all signs of massive negativity, but in the grand scheme of things, I think that's a positive. Like if I look at Coinbase, it flushed to the downside. Coinbase has actually bottomed out. If we look at the Ark complex of high growth stocks, the leaders, when I say leaders, they led us to the downside. These have collapsed. We're actually up quite nicely over the past week and making a little new high here as we speak. Notice, so yeah, it's not all rosy, but I actually think we've reached a little bit of a tipping point where your risk to reward towards buying or selling. Now, I've got to put on a new trade today. Do I want to buy something or sell something? I'm arguing for the buy side. And I'm arguing for the buy side because I think that the next couple of weeks are going to be this corrective phase where there's going to be some choppiness and we're not done with bad news and there's still going to be inflation this and Fed that. And yet I bet we'll see stocks kind of climb up here. Now, granted, do we leave this to the downside in the future? Probably so, right? We're in a bear market, but bear markets have corrections, just like bull markets have corrections. And what do you want to use those corrections for? Well, I just think that we've already run a race. If I'm a sprinter, I've already run my race to the downside, right? So the question is, it takes a lot to go just in the past 1 month. 1 month, basically, we've gone from 4,500 to 3,900. That's not insignificant. That's a lot of selling pressure there that's pushed the market down. If you go to the peak, it's even worse. But if we just take 4,500, where we were exactly 1 month ago, down here to 3,900, that's 13% down in 1 month. That's a big drop. So could we go further? Yeah, maybe, but I don't think the risk to reward supports that, given that I'm finally seeing signs of stabilization. And I look at those ARK type of stocks, those high growth stocks, bouncing as a big part of that. I look at Apple flushing to the downside. I look at all the negativity out there and so forth and say, hey, these are all things that we already know about. Don't tell me that the market's going to keep collapsing because inflation's high and because the Fed's going to raise rates, because that's already what's been priced in, right? So I think in order for the markets to go down another big drop, there has to be another shoe to drop. Now, that's always possible, right? That something that's not fully priced in, a negative turn takes place and the markets take another big drop to the downside. Certainly a possibility, but we'll look at this from the standpoint of risk and reward and such, and I suspect that we're going to be in a little bit of a recovery. So with that, the next question is, well, where do we search? Where do we hunt? Energy is the obvious sector to kind of look in because it's been so strong. And the thing I like about energy and why I've been adding to energy longs, like we've talked about in the market roundups, I have had positions in Oxy and Chevron, and I bought more of those in the past few weeks. And all of that's been working. I'm not going to focus on that sector because, again, I think that that's kind of stretched to the upside. And I think that trade, needs a little bit of a rest, perhaps, but I would still expect it to climb. And big picture, I think energy's in a great spot because it went through a horrific downturn. Oil prices collapsed, eventually going negative during COVID. And what happens when oil collapses? Well, not only do you have bankruptcies within the energy companies, but you also have some other factors in place, which is basically they cut production. They say, well, we're not going to keep pulling oil out of the ground and spending, $50 a barrel to do it if we can only sell it for 20, right? That's a losing proposition. So you had a slowdown in production. Now oil prices are ramping back up, but it takes a while to increase that production back up. And many companies, there's less capacity for that. Some companies have gone under. The energy companies that survive basically have less competition and so on. So they just have a good spot. If we look at the other sectors, I mean, all are in kind of these downward trends, but I think they'll bounce. I don't have necessarily a major preference amongst industrials or financials. I would say that the consumer stocks are a little worrisome, especially consumer staples, which just got blasted the last day or two. I'm not rushing out to buy them, but I'm going to hunt in a place that I have not hunted in for quite some time. And I'm going to call this the Ark Stocks, the Kathy Woods. If I were to say what's been the best over the last 2 weeks, you would probably not guess these ones. These led us to the downside. They absolutely, collapsed in many cases and are just seeing, might be a dead cat bounce, but you can make some money as that dead cat bounces. So the question would be, well, which of these stocks? And what I would basically go to is say, if we were to look at the ARK holdings, for example, and say, what do they own? Basically, I would go to a place where I would look for outperformers within this group. I would say, what looks strong? Now, there's not going to be much in the way of strength in most of these groups. If we were to look at this from the standpoint of, best and worst, I might even do it like this. We'll pull up both next to each other. And then from here, we'll just click through. And I'm looking for anything that's held up relatively well. Now, again, they're all going to be in kind of disaster scenarios. We know that. But I'm looking through them to see anything that's held up, maybe even in a little bit of an upward trend. Maybe it's above some moving averages, a little bit better than some of the rest. And let's see if anything stands out here. We might come back to Draftkings. Most of these have the charts look identical. There's just not a lot of difference. Look at that chart, and as we change it, it doesn't look much different, right? Let's just see if there's anything that stands out. And we're doing this on the fly. I'm just saying, okay, what has relative strength? Has anything held up better than the rest? Or do they all just, kind of went down together and bouncing back together? Let's keep looking here. Nothing that really stands out as being a clear outperformer. We're just, okay. IONS Pharmaceuticals, that's at least above some moving averages. Roblox, I know, has been a little bit better. It's actually had a little bit of a recovery here of late post earnings. Again, these kind of biosciences seem to be maybe a little bit better than some of the rest. Now we're getting into maybe the weeds here a little bit of smaller companies, maybe less volume, less open interest, less liquidity. So we'll have to be a little bit careful about that. And you always have to be a little bit careful with biotechs and pharmaceuticals in general. Those kind of move to the beat of their own drum. So I was just going to see if there was anything that really stood out as being something better. Deer is kind of which of these don't look like the other? Well, how about deer? I'm shocked to see that one kind of in the same group as all the rest of these. That's a bit surprising, but I don't see anything that's like, clearly head and shoulders above the rest. The Draftkings chart looked kind of interesting to me in that it didn't, you saw most of those bounced and then consolidated, and now they're trying to bounce again. This one's just had more of a bit of a bounce. Now, here's the way that I would kind of look at these in terms of opportunity. They were really, really beaten down names, and generally speaking, here's my theory and my philosophy on things, I don't go from a massive bear market to expect a huge recovery. That's just not really how things work. Usually, when you're in this situation, there's just what we call dead bodies or overhead supply. You have to understand that some people bought this stock up here and here and here. So as this thing tries to bounce, it's going to encounter sellers, and it's going to be a big process of trying to recover. And we're going counter trend because most of these just are counter trend. So, you know, I was hoping we would find something that was a little bit more established. Here's what I wanted to see. I wanted to see something like this. Imagine you had a stock that had its 20 crossing above the 50, and maybe that stock had already broken out and was maybe giving us a pullback like that. That's what I was hoping to see. All of those stocks seem to be, really, I think it speaks to just the group. That group was basically sold off together. There wasn't really a big differentiation, one better than another. They all just had the same chart pattern. They sold the entire group. Now the entire group's bouncing back. But this type of setup would be more of what I would want to see. I'd like to be buying in a pullback versus a break higher in a beaten down stock. And I'd like to buy it once the trend is starting to turn. And we don't really have that. So, I can't in good conscience kind of build a very bullish structure here. If I were going to trade it, I would basically trade it, kind of what we say is a chicken bullish trade, where you put on a trade where if it goes sideways, you make a little money. If it goes up a little bit, you make a little money. You're just betting it won't go down in the short term. So some sort of diagonal or something like that, I think would be more of the way that I would be looking at this in terms of a possible trade. So let's consider our options here. I, again, just don't want to be super bullish with this. I don't think it makes a ton of sense to do so. So if we were looking at it, stocks at 1448, you could really build something. Now, I tend to trade a little bit longer duration than some of our other traders at Maverick. I work on an operating theory that works for me, which is it's much easier for me to know what is going to happen than when it's going to happen. Okay, the what, I know enough about the markets, about, fund flows and sector rotation. A lot of things make sense to me in terms of what, but the when, getting the timing right is always the most difficult aspect to kind of pinpoint the right time and exactly, like I can't say, well, Draftkings, it's going to, it'll go up for 2 days and then it'll pull back for 3 and then it'll trade up for 5. It just how, what's going to happen? Well, I think it's going to be stable. And I think it should be a pretty good stock here in the near term. When it's going to happen and how it's going to get to the upside, that's the more difficult part. So usually where you'll see a lot of Maverick ideas that are pretty short term, I would actually tend to go out a little bit further and a little bit deeper on this. Like I would be looking at probably buying something that's multiple months out and saying, okay, I'm playing for some stabilization. Just because I buy August doesn't mean I couldn't take profits on this in June, right? I could get out early, but I'm going to buy myself some time. Usually with my diagonals, I want the call that I'm buying to be a little bit in the money so that I get a higher delta. That means it'll act more like the stock. If I flip to the delta column, see it's a 70 delta, so it acts as though buying this call is similar to buying 70 shares of the stock per call option. That's the way it's going to act and behave. Now, if I buy this one, I need to sell something against it, and we've already sort of elevated to the upside. So I would be more inclined to buy the August 1250 call like we were looking at, but sell. And usually I go out a couple of weeks to even a month on the option I'm selling. And in this case, I'm just not going to go very high. It's going to be a little bit chicken in the short term. And the way that I would trade this is probably as follows. So first, let's analyze the trade, and you'll see some of the dynamics here in place. Let me get this to see if I can get that price to go like that. There we go. And let's see, we got to uncheck some of this other stuff. I don't know what that is for sure. We can, just highlight the diagonal. So now this trade is just highlighting the diagonal spread, and it kind of shows you the progression of this thing. So if I fast forward over time, that purple line is the progression line. It kind of shows me where I'm making money, where I'm losing, and you can kind of see that as we go from today, where we're at break even because we're putting it on right at current prices, right? But what do you see as the progression? Watch the purple line and watch the progression of this thing as it moves. What you're going to see is as time moves forward, okay, that purple line goes up to conform to the blue line over time until we get to which expiration? The first one, June 17th. At which point you're just left with this risk graph, right? But it shows you some important things here. It shows you that the way that this trade is constructed, if the stock goes the wrong way, which for us is a sharp, deep dive, if this stock is going this way, we're heading to negative numbers. But if the stock, which is right around these levels right now, goes this way, you can see even if it overshoots the mark, we're in a pretty good spot here if it goes to 16 or 17. So even if there's a good recovery and it kind of overshoots the mark, we're still in the profit category. The ideal is for it to finish kind of in here. But the way that I would look at this is a trade where you're basically getting upside, but you can adjust the June 15 call. This is the core portion of the trade, is the August 1250. That's kind of the underlying core position. This is the instrument you're trading against it. And by trading, I mean I will very likely adjust or move the June 15 call. Now, if I get out of the trade, I might close the whole dang thing, but I'm not going to be messing too much with the August call. The August call is probably more set it and forget it for a while. The June, I might consider some things. So let's imagine a scenario where we become a little more optimistic. Maybe a situation where the stock, well, let's drop a scenario. Let's say that the stock, here's its chart, maybe it bumps around here for the next couple of days, and you can see the probability cone. It says between now and that first expiration in June, this stock could be anywhere down to 10 or up to 18. But let's say it kind of bumps around and maybe it pulls back. And I feel like this is an even better setup. Okay, we get more of the bullish setup. Well, I could buy back that short call and then sell a higher strike call, roll it up in strike, give myself more room to the upside so that as the stock makes the run, I make even more money. Or maybe the stock goes up and I think, I'm going to stick with it because I think it'll pull back. And then when it pulls back, I buy back that call and roll it up. The point being that just because I've sold this 15 strike call in June doesn't mean I have to sit there and stay in the June 15. If I think at any point in time the stock is going to make a move that's going to go above and beyond 15, then I will probably roll the trade out, buy back the June 15 call, and sell maybe the 17 strike call in its place. Close this one, sell that one instead. Make a change to the trade if this trade is working. If some profit is building, I'm far more apt to stick with it and make a bullish adjustment. And that might go against your greater instincts because you might say to yourself, well, it's going up. I've got a little profit. Maybe I should close it in a hurry. Maybe I should lock in those gains. And what I've learned from experience is definitely that when you're in profitable positions, trading is much like gardening. You want to pull weeds out of the ground. You want to get rid of them. Okay, bad trades are weeds. Get rid of them. You don't want to cut your flowers, right? You want to let them bloom. So that's what good trades are. The progression of this thing will be important. I'd expect it to kind of chop around a little bit, but the likely scenario is to adjust that portion, that leg of the trade. Realistic expectations. I do think that Draftkings, if we come back to the probability cone, I do think that it can work its way by June expiration up into that $17 or $18 per share level. I'm not starting it off super aggressive, but I might adjust it to more aggressive as the stock works its way higher. So that's, kind of my thesis for where we're at in the markets and how I think the next couple of weeks will go. Now, the market, of course, is the ultimate judge and jury, right? It will basically grade your expectations based on your profits and losses. But I feel good and comfortable about making a bit of an adjustment to a little bit more bullish outlook right here. Good question came in. What if you are trading earnings? So we always check, before actually acting upon a trade. Of course, you could check the earnings date. Like, for example, if you wanted to see, you could just say, when does DKNG report earnings or whatever, and it would give you the date. Okay. And here you can see that the expectations, well, the date for earnings are coming out in this trade. I have no problem placing trades. So it reported on May 6th. We're past that, but I have no problem if this were to report during the life of our trade to actually trade it through earnings, if that was the case. Okay. In this case, we've already passed it, but I don't usually have an issue with that. In this market where stocks are exploding on earnings in a bad way, look at Target, a huge gap down. That's massive. I mean, you're talking a multi-billion dollar corporation going from 215 the prior day and gapping down to 163. I mean, that doesn't happen every day. You put it into perspective, that's like a 25% drop. 1/4 of its value just gone overnight on earnings, and such a big company. And Walmart, the same thing. And Cisco reported and had a big gap down overnight, and it's down 15%. We're definitely seeing a different earnings environment in 2022. There's no question. There's more volatility. So if you wanted to avoid earnings for right now, given the blowups, I get it. Okay, but normally it's not this way. Okay, so there's kind of the question of, is there more of these blowups in 2022? Yes. Why? We're in a bear market, and in bear markets you'll see more blowups. That's just the way it works, right? Rising tide lifts all boats. In a bull market, you don't see as much of it. When you've got a sinking ship, well, some of the ones that are going down will go down in wild and dramatic fashion. What was DocuSign? DOCU? Again, an example of this happened months ago, but kind of a precursor to others. You can see just how volatile these things can be. And I think the one that I was referencing was even worse than that one that you can see on the chart. It was right there. So if we were putting these into perspective and looking at these gaps, DocuSign in its last two earnings reports has had some pretty darn dramatic drops here from 230, and the next day it's trading at 130. Almost half of its value gone just on that earnings report. So through earnings, the trade that makes the most sense so far year to date on earnings has been long volatility trades. So buy a straddle, buy a strangle, buy a call, buy a put, specifically puts, obviously, because most of the disasters have been on the downside. even the largest companies out there, Amazon had a huge gap on earnings. So definitely a lot of volatility to your point. If you want to pull up earnings, I always go to the earnings calendar at Nasdaq. And if you go to the, whoops, where's my Nasdaq earnings calendar? There we go. So if we pull up its earnings calendar, this is kind of nice because you can click on dates and see what's reporting on certain dates and times and that sort of thing. So that's kind of fun. Well, I hope you've enjoyed it. We've got a trade idea in DraftKings. It's a little odd compared to how we normally trade because it's counter trend. I just couldn't find anything in that growth complex. But oddly enough, these are the stocks that over the last couple of weeks are holding up relatively well. So I'm not, suggesting that this is something you should be betting on going massively higher, but I think there is stabilization in the chart and we can assess that. Make a little bit of money on it. I don't typically, we kind of had to force the action a little bit because normally we'd want to see a little bit more of a trend reversal and that sort of idea. In the market roundup on Tuesday, my favorite ideas were on the short side, but I think those have come and gone. I was going to highlight them if they were still set up, but they've made dramatic moves. Archer Daniels Midland, we highlighted that, and since then it's gone from, well, that was the day I highlighted it. It's at 89, and today it was trading at 82. In 2 days after highlighting that, it's down 8%. So I think a lot of the bloom is off the rose, so to speak. A lot of that, has maybe already played out. So I'll rewind back to Tuesday. Well, there were some definite good opportunities that way to the downside. On the long side, high growth names just for a little bit of stabilization in the short term. I wouldn't go much further than that. Specifically, DraftKings holding up relatively well, but still in a downtrend, so not picturesque, but that's what I've come up with. Thanks again, everyone. Hope you've enjoyed it. Have a great rest of your day, and we will see you next time. Goodbye, everyone.